All right, welcome back. Another episode of Chart Talk. What a crazy market we have seen in the last 2 weeks. So, gonna have some visuals here. Again, it's the Qs. We have this massive flag that's been forming going back since November. Qs couldn't break these highs. This 640 highs. Retested it kind of the beginning of the new year, and then we had this 2 months of just choppy, you know, weak action. And then we had that shakeout of this macro support. And it did seem like this was kind of doom and gloom. Again, at this point in time, market seemed very toppy. We had, we talk about the stages, very clear breakout stage going back from May, May into October, stage two breakout. Chart's getting a little wonky. Stage two breakout, stage three topping patterns, what it looked like for many months. And then we got that breakdown, and it seemed like, everything was super weak. Everything was breaking down. It seemed like we were entering into, a breakdown stage. But we had, for the S&P, we tagged the 10% correction Qs, same thing, just right at the 10% correction. Now in hindsight, again, just came right into this bigger pivot low. Again, when everything looked the worst, in hindsight, was the best time to buy. Again, I wasn't really doing much, into the start of this correction. I was, again, like I think most people, expecting more of, the H pattern and breaking down, just given the past, 2 months or so, just very weak action across the board. But we got the ceasefire, market snap back with a vengeance, and this is probably this most aggressive V bottom I have personally ever seen. And again, this trend line is just, cuckoo for Cocoa Puffs. As long, this trend is going to stay as long as it can, but this extremely vertical trend line is not going to be one that can be sustained, obviously, in the long term. So again, this is a 70-point range in the Qs. The measure move of that really should send it eventually to 700 at some point this year. This would be, again, I would highly doubt this trend line is going to just, we're going to just vertically climb to 700, but that is eventually where the target's going to get to. Maybe we start to, retest this and turn this into support. Really anyone's guess. But the main thing is really this extremely steep trend line is not going to continue for, the next few weeks. And the other thing is we're probably not going to see these lows again for quite some time. And when we do see them, a lot of the talk, the conversation I've been having, people saying, "Oh, I'm going to wait for this. I'm going to buy back when this retest is slow." And that's the worst thing. You don't want to wait. Waiting, but you don't want to wait for that falling knife, because when it does get one eventually, or if ever gets back down here, the odds that the trend is more likely to continue lower than it is to magically hold there and do what it just did. This is like a once in a lifetime kind of anomaly of a market going from effectively 52-week lows to 52-week highs, a 2-week span. It's crazy. Again, I'm just gonna switch over to the S&P. Even crazier. Again, this is might as well just put a vertical line here, because this is the most insane trend line. So if we're drawing out the V here, the most aggressive V bottom again I've ever personally seen. So again, you don't only want to be betting the farm after this major run up, just like you don't want to be selling everything at lows. But it does start, we're starting to see a bit more of these like megaphone or more broadening patterns starting to form. It's also very clear in like the telecom sector, we'll get to in a moment, but a very clear broadening pattern. And again, eventually, the target here in time is like 760, 770 in the S&P, just given the the pullback and more of the break of this horizontal resistance than the megaphone I'm drawing out here. But again, definitely very tricky, very confusing for a lot of people, myself included, this has definitely not been an easy market to trade. But at the extreme ends of those moves is not really the time when you want to be going crazy. If you miss this vertical run, trust me, there's plenty of people that also missed it. You still need to wait for actual setups. You can't just be blindingly chasing names right now. So again, a lot of very strong sectors right now. Again, dramatic pivot from what the action was a few weeks ago. You can almost see, the very clear weakness on the left side, and the rally back higher is just mirroring, the sell-offs. It looks, the recoveries, if you took a mirror, it looks almost like the same. So again, for a lot of these sectors, it's really just, if or when. It's more if, not it's when, not if they're going to get back to these prior highs. A bit of a tongue twister. So most of these sectors, if you're in them, you're holding them. If you do want to get out or take some profits, when it gets back to this retest, that's going to be kind of the recurring theme here. Again, we talked about, telecom, that, the broadening pattern, like we're seeing the S&P, very clear broadening pattern, telecom sector. And again, with this vertical climb, more than likely, we're going to see a test of this, upper area of this channel. Then it's going to be, seeing 170 again. So if you're already in and holding names, this is the time where, again, if you're thinking of bailing out of stuff 2 weeks ago, and now whatever you're in is you're getting this amazing rally, it's kind of that gift that can let you, bail yourself out of those names that you aren't fully committed to, but you just want to systematically get out, not just blindly selling because they're going up. This is where you can very easily raise a stop versus the prior low a day, and eventually when the name is going to turn, it'll show you that. So even like, again, you can see with even the REIT sector, if you're in it from as of today, stop first 95, probably runs back up to 100. Next day it's a 97. You keep raising the stop, and eventually you get stopped out when the name starts to roll over. But you don't like prematurely give, a lot of these current winners away too soon because you or I think they can't go higher. So again, mid caps pushing out the new all-time highs, unlike the Qs and the S&P that, very steep V bottom off the lows. The mid caps, and more so small caps, have been setting up in a much more defined manner over the past couple of years than the broader indexes. So you have, small caps basically in a massive 5-year flag. You probably even call it like more of a cup and handle. This is the prior all-time highs, this area right here, breaks out, retests, prior resistance, starts to turn into new support, and now we're seeing that rocket higher. And very similar action with the mid caps, where not as defined as a small cap breakout, but not as extended as the overall the overall index that is much higher than small caps is like effectively like right here. They just they based out for a couple of years, and small caps are like just now starting to break out of that major base, where the broader indexes are just so much further away from that equivalent breakout area. Again, semis, massive breakout. It's still very interesting that NVIDIA, biggest player in the game, is still battling it out just to retest prior all-time highs. But it does seem more of when it's going to get there than if it's going to get there, just given how strong the semi sector really has been in this rally, just very clearly showing us price actions higher. So again, consumer discretionaries, this is a weekly chart here, and I can't even make the V for just how aggressive this recovery has been. So a lot of strength out there, definitely catching a lot of people by surprise. And when that happens, people tend to chase. People try to make decisions more emotionally than rationally, and that's just something you don't really want to do at this time, because a lot of these the upsides here are very limited after this major run up. So Yes, do a lot of these sectors push higher in the short term? Sure, or more than likely. But your real risk is 10, 12% lower for 3 or 4% or 5% more of upside. Again, I'm just talking about some of these sectors, not individual names. So again, utilities still flagging out, consumer staples, still a little weak, not really participating in this rally, and biotechs still flagging out at this macro resistance level, very similar to the small caps. So with a lot of these names, or I'm sorry, with a few of these sectors, we're seeing small caps breaking out, we're seeing mid caps breaking out. And if you don't really want to be chasing tech up 10% or semis up 12%, and you're looking for a more actionable setup, something like this all-time high breakout in biotechs is setting up on very defined risk, where it's not extremely extended on its daily or weekly. It's still, poised for a potential move higher in time without having to chase. So that's where something where, we get a little bit more of a push higher. We see some weakness. You see a lot of those sectors that have gone as parabolic as they can start to roll over. The smart money is going to look at, the sectors that haven't played as much catch up like this, like staples, like utilities, like healthcare. But for right now, they're just not ready, just yet. So I know a lot of people have been, it's been hard to find actionable setups given this run up, and I'm with you. Again, this car is the craziest chart by far of this year. And again, I can't even show how, given how much this name has moved, these like candles look so tiny, but as insane as this car has been, it has increased $500 a share in a month. It has gone up 5 times, 5x. Now, when it comes to holding a winner, again, I have no position in a car. This thing is too crazy for me, but this is a great lesson of when you're in these names, you don't know when to sell them, but if you can simply just know how to raise your stop systematically, it can keep you in at any point. If you simply bought car through any high of day, again, we always focus on buying through the high of day. And if we're wrong or when we're wrong, we look to get out through the low of day. So if you bought it through 100 and you trailed that stop versus the prior low of day. So if this is the day in question, it's Wednesday, April 1st, you're already in car, your stop is the low of March 31st, which is here. You say you chased it, April 7th, you bought through the high of day, you had your stop below the prior low of day, and you let the name continue to trade higher, you're still in the trade. And each subsequent day, typically by mid-afternoon, let's say it's this day, April 13th, if you're in from that day, prior low is 250, that's where your stop is. And even, each day, especially as things got through 400, I'm like, it can't go higher, it can't go higher, it can't go higher. And today is its biggest day again. It's probably at this point getting very parabolic. There's probably going to be a massive like doji candle through highs tomorrow, and that's going to kind of be the blow off top. But the key thing here is at any point, any of these days, whether you systematically bought it through 100, you systematically bought it through 150, that little flag here, or you knew nothing about the market and blindly chased car at any point in this rally, and all you had was a stop below the prior low of day, you would still be in this trade. And each day it looked insane. Again, this is the craziest chart of the year, but never once did it fail that prior low of day. Now, the day that does happen, this thing is screwed, just like when this happened a couple of years ago. It has a massive runoff and then it dies. So this will end the same way it ended last time, but it's just been a awesome thing to watch. And if anyone is in this, please have a stop below the prior low day, because when this does turn, it's going to turn just as fast as it ran up. So craziest chart again, but main thing really here is just that lesson of having a defined exit. You can ride these things as high as they can go. And when they turn, again, you're not going to catch the top of any of these moves, but you'll be in for the meat of the move. And that's our main focus, is just being along for most of the ride. We don't care about being in it from the dead low, the dead high. So again, a lot of names have been basing out the last couple of weeks, have been starting to break out. Again, this Etsy, we had this base breakout through 56, nearly $10 higher. Ulta, we had that alert through. Let me zoom in more so it's a little bit easier to see. We had that alert through 542 this week. Wasn't the best entry day one, but again, great day two, day three action. And then it's just to get into this gap fill area. Again, looks great. This AMSC, another base breakout through 35, doing phenomenal. eBay, nice blue sky breakout through 100. So again, a lot of these names, there were actual setups. They were, some of them, again, this eBay was a pretty tough entry given the run up it had. But this market has just been, kind of relentless. The Cisco we've talked about last couple of weeks through 80, nearly 10% higher. Again, retesting that per all-time high. So would expect some resistance to kind of come in this area. But again, nice 10% move. NBT, blue sky breakout that we were talking about a few weeks ago. Just kind of gap and go, 15 points higher. Spot through 500. Again, a lot of these alerts, anything I'm talking about buying, any alert that I've spoken about last week or two, it's going to be higher today. So again, you have to take this with a grain of salt. Every alert that I talked about is obviously higher given the market, but there is still setups. They still are defined entries. These aren't just blindly chasing. It's, this spot set up for many months, Cisco many months, eBay not so much, but a lot of these other bases, these are, multi-month setups, and NTES is one that hasn't gone yet. Kind of a bit of a red flag, but packaged software names have been, kind of left in the dumpster, so to speak. But, this name has been starting to base out, has been putting in some nice higher pivot lows recently, probably still needs to pull in some more. But the next time it can get back up to this 120, we probably see a nice breakthrough space like some of the other examples that we've, gone over. Again, we talked about biotechs before, not really participating in this recent rally, but the sector overall flagging at all-time highs, looks phenomenal. Broadly, the COGT biotech name that, again, you kind of have these two different trend lines kind of lining up. You have this diagonal trend line break. You have, more of this horizontal trend line that I tend to focus more on. Again, probably takes another week or two to kind of tighten up in this flag here, but nice setup through this 37, 38 area versus this 35. So keep an eye on that one. Another, pharma name, this CYTK. Our buddy Kevin mentioned the same 2 weeks ago. Again, nice little flag got through 68. Eventually that 70 breakout as well. We had this alert a few weeks ago. I know Tim is in it, and our Tax Pro Skender. We had that breakthrough, that 213. Again, one, vertical run up back into the prior all-time high area. So again, you catch a 40-point run up in 2 weeks in Amazon, this is kind of the time to look to take some profits. Again, it could, start to flag out here, and eventually we should see, this 260 breakout in time, but this could take months, a year, 6 months, who knows how long to develop. And that's why you want to, when the market's trading or names are trading in these ranges, and, very short term, yes, vertical move higher, but broadly since October, it's in this 60-point range. You want to, be able to trade those ranges so it's easy to hold some for the bigger move. Even this like ALL is a good example of this, where if we go back, to March of last year, this name has been in a 40-point range for a year. Again, it started to tighten up over the year. But if you were waiting for this 216 breakout, you waited all year while this name just was range bound in 40 to 20-point ranges, where if you can trade those ranges, it can be very, you want to take those profits when you can, so you can get back in. Again, for us, we were just waiting for this breakout, blue sky breakout in it. But for a name like Amazon, again, we can see broadly the sideways action this name has been in. Even like Nvidia, very much in this wide range, that you do want to be able to take some off into these resistance areas if that area is going to continue to hold, which, for Nvidia, it's been doing that all year. Amazon, same thing. You want to be able to trade those ranges, and these kind of run-ups, you want to take advantage of them when you can. O'Reilly, another big, pretty big base here. Keep an eye on this 94.50 versus 92. Again, GD, got the little wartime pop, but has since faded, so not looking at that. Amgen, another biotech name, another little mini base here forming through 360. Need some time though. And last but not least, this Netflix, again, name was super weak post stock split, which was, again, we talk about why do we avoid stock splits. I'm going to delete some of these lines, but why do we run for the hills when they split the stock? Netflix split their stock on this day, and every day for the next 3 months, this thing sold off. This is why we avoid stock splits like the plague. Now, it's run its course. Again, even Tesla and Amazon, when Netflix, Apple and Tesla all split their stocks, they all had similar 1-2 month corrections. Netflix obviously ran its course and has since left that breakdown stage and has started to base out in this like 10% range here. So, tried the breakout, gaps out on earnings, and for now it's just back inside this 10-point range. And the only thing we care about is if or when it gets back to 100 the next time for that, next kind of push higher and then eventual climb back to, retesting these all-time highs. So just keeping an eye on this to, set up in this flag. If it takes a couple weeks or so, just keep an eye on that 100 area. So again, market has been crazy. If you feel like you missed out on a bunch trading wise, again, this is very difficult. I don't think anyone really saw this coming after the fact. Of course, everyone's going to say, yeah, market's going back to highs. But in reality, when the market was down here at 630, I personally thought we were heading, at least sub 600. That was kind of really where I thought we were going to break down to. I did not expect to see new all-time highs in 2 weeks, the fastest we've ever really seen it the last like 50 years. So this is really why you want to have two different investment approaches. So what I've been trying to teach our members for many years is very simply to have a majority of your money invested very passively in long-term accounts, whether you're buying the S&P, whether you're utilizing the big picture model at M1, whatever it is, it's consistently buying. So for myself, I didn't call this as the bottom, but I invest in the big picture model every single day, Monday through Friday, in small amounts. So I didn't think that was the bottom, but via automation and repeated daily debits out of my checking account into my investment account, I caught this low. I also bought every single day on the way back up. But when you do that, and you've done that for 5 or 6 years, and the market is here, your account can only be at all-time highs. So that is why, and no matter where you started this, I could have started this consistent investing at any prior all-time high, and it still worked. And that's where, again, in this moment, it seems like this is the high of forever, but that was the same feeling it was at 600, the same feeling it was at 500, the same at 400, 300, 200. All these big round numbers, it always feels like it's never going to go higher. But at any point, if you start consistently investing and you give yourself enough time, the results will show for themselves. And a majority of my money is in this very simple methodology, just consistently daily, buying every day into the broad index. For me, I utilize the big picture model, and I have a smaller percentage, around 10% of the money, where I'm going to actively trade and try to beat what the passive account does. And the last month, there's no way I could have beaten this run up, but the bulk of my money was in the big picture and it did all the heavy lifting for me. So when you have both of those approaches working for you, and one isn't working that well, the last month when the market was dropping, it was much easier for the active account to sit in cash, which for most of us, that's what we were doing. So that account was doing better because we weren't losing anything. And now we get the snapback, and now big picture picks up the weight. So when you have these two approaches working simultaneously, it's which one is doing better. And that's the one I want to focus on. Not, am I beating the market or is the market beating me? And I feel like for a lot of people that I've been talking to that aren't members, it's been that the market's beating me, I don't know what to do kind of thinking, where for those that follow this approach, it wasn't fun the last month or two with the market pulling in, but now we're back at all-time highs again. So again, I'm going to end it there. Don't bet the farm on anything at these highs. Focus on all these bases, focus on some of these sectors that haven't gone on these extremely vertical runs. If you are in them or in anything and don't have a clue of how or when to get out, a general rule of thumb is just prior low a day. You're looking at VGT if you're in the tech sector and you don't know what to do after this 150 point run up in a week. Stop below 800, keeps you in if it wants to continue higher, and if it's going to roll over, it gets you out near the top. Ironically, they're splitting their stock in a couple of days, actually tomorrow. So we'll see if the split holds true with tech. So hope this is helpful in any capacity, and good luck, and we'll see you next week.